Welcome to Wednesday Web Chat. This is Carl Lewis, your host from Vision 33. And today we're going to be speaking with our good friend at Avalara one more time, Scott Peterson. And I'm going to stop sharing so that you can share your screen.
Thank you, Carl, and good day to everybody. It's nice to be back. Let's talk about the things that are important to all of us, which is how do we avoid getting audited? Or if we do get audited, how do we avoid the unpleasant consequences of audits? And I'm going to go through some of the changes that are going on in the United States today in the States and not the United States on state tax policy. As I go through that, I'll be talking about how these things impact auditing. So that's me. And just a brief agenda here, some of the things going on in e-commerce, a remote workforce. All these things are issues that, if not managed carefully, result in bad audit outcomes. Just a minute here on, everybody knows what's going on in the economy. Up until the recent invasion, our economy was screaming. It's still screaming. Even with the inflation and all the things that are going on right now, but everybody's moving toward the internet. All retailers have made some change because of COVID, obviously. Otherwise, they wouldn't be retailers today. The pent-up demand that has come from 2020 exploded into 2021, and it's continuing on today. We're seeing enormous increases in spending, and when you have enormous increases in spending, you have enormous increases in sales tax collections, and likewise, there's some very serious increases in personal income tax collections around the country. So let's talk just briefly about e-commerce. We're 3.5 years now past the Supreme Court's decision in Wayfair, South Dakota v. Wayfair, and we are almost, not finally, but almost to a spot where every state in the country has this law in effect. Missouri is the last state to actually adopt an economic nexus statute. Economic nexus is the phrase that we all use to describe your obligation as a merchant to collect some state sales tax based upon the sales you make inside that state. This historical rule in the United States was physical presence. And that's what the Supreme Court struck down in 2018. Prior to that, they had created a previous rule, and the previous rule was that no state could require you to collect sales tax unless you were physically present inside that state. They, over time, realized they didn't like that outcome. It didn't give them the ability to actually analyze. And this is the irony of this. All of these Supreme Court decisions are based upon the Commerce Clause, in the undue burden on interstate commerce, which is prohibited in state tax systems. So the theory is that no state can impose a tax on someone if it imposes an undue burden on interstate commerce, because Congress regulates interstate commerce, not the states. Congress doesn't really regulate commerce like the Supreme Court would like them to do. But so in 1967, the Supreme Court did it. Supreme Court in the case, they regulated interstate commerce by adopting this rule that said that a state can't require someone to collect sales tax unless they're physically present in the state. What they realized thereafter was, by having that rule in place, they could never, no case would ever get to them that would allow them to actually determine whether or not a tax was an undue burden on interstate commerce, because they stopped them all before they could get it in effect. So they've repealed that now. So now we've got all these taxes that, in theory, will someday be evaluated by the Supreme Court on whether or not they impose an undue burden on interstate commerce. Well, so every state's now got this economic nexus statute, except for Missouri, and theirs, in theory, goes into effect on January 1 of 2023. What it means is that in addition to having to collect sales tax if you were physically present in the state, because that rule didn't go away, it just got supplanted, you now have an obligation to collect sales tax based upon where you make sales, which means your customers drive where you collect sales tax. In the old physical presence world, you drove where you collected sales tax because you drove where you were physically present. In the new world, that still exists. You open a store in Cheyenne, Wyoming, you're going to have to start collecting sales tax in Cheyenne, Wyoming. But now customers who live in Cheyenne, Wyoming can drive you to having to collect the sales tax in Wyoming, in addition to you opening a store there. This map is representation of the economic nexus threshold. In the Wayfair decision, South Dakota's law, which is what the Supreme Court evaluated, said that if you make more than $100,000 of sales inside of South Dakota, or 200 separate transactions, you have to collect their sales tax. And while the Supreme Court didn't say that was constitutional, what the Supreme Court said was that they liked the fact that there was this threshold, from the Supreme Court perspective, that was an exception for small sellers. So the Supreme Court liked the fact that really small sellers weren't going to be burdened by having to collect South Dakota sales tax, because South Dakota had this threshold, this $100,000. If you were below the $100,000, and these numbers were pulled out of a hat by South Dakota, then you weren't burdened with the obligation to collect the state sales tax. Supreme Court liked that. That's about the only thing that the Supreme Court said that all the other states picked up on. And so what this map shows you is how the states have implemented the one thing the Supreme Court liked about South Dakota's law, which is that small seller threshold, the economic nexus threshold. So the blue states are the $100,000 or 200 transactions. The pink states are the $100,000. The light orange are the two states that have a $250,000 threshold, and then the dark orange states are the three states that have a $500,000 threshold. That means that you're not required to collect sales tax in those states until you exceed the threshold in that state. So Wyoming, it's $100,000 or 200 transactions. So you don't have to collect the Wyoming sales tax until you make more than $100,000 in sales in that state in a calendar year. Now, these are all calendar year driven. Okay, so this is where we're going to first talk about audit risk. These laws went into effect starting in July 1 of 2018. And the first three states that this law went into effect were Hawaii, Kentucky, and Vermont. Their laws all are like South Dakota's, $100,000 and 200 transactions. And they're all triggered on a time period. So the laws in those three states say that if you make more than $100,000 or 200 transactions in the current calendar year or the preceding calendar year, you have to start collecting sales tax. What's happening today? So remember, these laws went into effect in July 1, 2018. The current calendar year was 2018. The preceding calendar year was 2017. So your first audit risk, because of the Wayfair decision, is now because of time. If you are not collecting sales tax everywhere, and you should only collect sales tax where you're legally required to, but if you haven't been paying attention and you're not sure whether or not you should be collecting sales tax, the state's not going to talk to you about today. So if Hawaii calls you today and says, why aren't you collecting our tax? They aren't going to ask you about 2022. They're going to ask you about 2017. And they're going to make you prove that you didn't exceed their threshold in 2017. Had you exceeded their threshold in 2017, had you made $150,000 in sales in Hawaii and not collected their sales tax, because remember, you weren't legally required to collect sales tax in Hawaii in 2017. You didn't become legally required to collect sales tax until July 1 of 2018. But the way Hawaii's law is written, they look at 2017. So if you made $150,000 for the sales in Hawaii in 2017, Hawaii's law presumes you started collecting sales tax on July 1 of 2018. Now, if those facts describe you, the state is going to issue you an assessment. And this is what they're doing today. They're making the assumption that you were engaged in business, and that you exceeded their economic nexus threshold, and that you owe them back taxes. This may or may not result in an audit. Depends upon how big you are, how well you're able to prove that you weren't engaged in business, or that if you were engaged in business, it was a very minimal amount of business. But if you aren't able to do either of those, this will result in an audit. And oddly enough, Hawaii auditors travel. They have to travel. And you shouldn't, in fact, they have offices in California. And so they have offices where they think their customers live. And we're going to start seeing states issue audit assessments based upon a presumption that you're going to have to defend. And this is going to play out all over the United States this year and the next couple of years. And it's not going to be very pleasant, because we're talking about, 3 years worth of assessments, 3.5 years worth of assessments. And it's really important that you start looking at these things if you're not collecting sales tax everywhere today. Now, remember, these thresholds are things you step over. Imagine a door. Imagine the threshold on a door. You're not inside a room until you step over that threshold. Likewise, with sales tax collections under economic nexus, you're not obligated to collect the tax unless you've stepped over the economic nexus threshold. You have exceeded by $1 that $100,000, or that $250,000. So remember that if you consistently make $45,000 worth of sales a year into South Dakota, you haven't stepped into their room. You haven't crossed the threshold, and you don't have to worry about those sales. Now, they may disagree with you, and they're going to, and when they do call you, and then when they ask you, and this is the second thing to be concerned about in an audit under the new economic nexus rules that we live in, is that if they don't think they can prove that you had economic nexus, they're going to start asking you questions about physical nexus. Do you have any employees in the state? Do you have any property in the state? Do you have a store in the state? Do you deliver what you sell in your own vehicles? Those are the 4 triggers, other than having a store. So there's 5 triggers. The 5 big triggers are: you have a store in the state, you have property stored in the state, you have employees living in the state, you deliver your goods in your own vehicles. Or maybe there's only 4 triggers. Take it back. Maybe they're just 4 triggers. And they're going to ask you those questions. Normally, well, if we lived in normal times, and we've stopped living in normal times 2 years ago, if you lived in, I'm going to go to this one right here, this slide here, and then I'll go back. If we had still lived in normal times, all your employees would be in your office, and you wouldn't have this concern about remote workers. And if you have the next thing that all of us need to be worried about when it comes to audits is remote workers, because remote workers create physical presence. Physical presence creates an obligation. You cross that threshold once you're physically present inside that state, and you then expose yourself to whatever tax structure they have in effect. And these tax structures are quite different from each other. So when they ask you where your employees are, if you have employees today who work in a state other than the state you hired them in, and they're doing so because of COVID, and they can now work from anywhere, and you're happy with that, think about where they are and think about whether or not that's going to create physical presence to you. It very likely does. And so now you have an audit risk, because now when the states, you've proven to them that your sales are below their economic nexus threshold, and they're starting to ask you physical presence questions, you want to make sure you know where your employees are so that you know how to answer those questions. And you need to be able to think about how you've now exposed yourself to something that you didn't otherwise have to do. So I want to go back here just for a second and talk about the next issue that's audit related, and the way to help yourself in an audit. And folks don't have enough appreciation for what they don't know. And the tax structure that exists state to state to state seems relatively straightforward. 42, 43 states have personal income tax. Okay, you think, okay, I have personal income tax. I know what that's like. 40 states have a corporate income tax. Okay, I pay for corporate income tax in my home state. I know what that's like. 45 states in the District of Columbia and Puerto Rico and Alaska have a sales tax. You think, well, I live in a state that has sales tax. What we don't appreciate enough is how different these sales tax are. The California sales tax is radically different than the New Mexico sales tax. California's is a little bit like Colorado's, except in Colorado, they've got 70 home rule cities that do whatever the heck they want to do. They have whatever rate they want to have. They have whatever return they want to have. They have their own auditors. They have different definitions of what's taxable. And even when they have the same thing that's taxable, they don't have the same definition. In California, the cities and the counties tax the same thing the state does, 99% of the time. Colorado, they rarely tax the same thing the state taxes. And they often don't tax the same thing as each other taxes. So you get audited by a city in Colorado, it's going to be significantly different than the next city that audits you in California or in Colorado. And it will look completely different than the audit you get done by the Department of Fee and Tax Administration in California. And it's going to be different because they tax different things. They have different definitions. There are going to be more of them in certain states. And the rates are all different. The boundaries are all different. You get audited by Wyoming, you're in pretty good shape. The sales taxes in Wyoming are county-based, and it's virtually impossible to charge the wrong local rate in Wyoming because it's all county-based. And then a 5-digit zip code gets you pretty close to the right answer almost all the time. Unlike any place where the tax is imposed at the city level, city boundaries change, and they change a lot. And the zip codes are an extraordinarily poor representation of a city's boundaries, just unbelievably poor. So if you use zip codes to manage your sales tax compliance, this is an audit risk. And your audit risk is now extraordinarily larger than it ever has been in the past because of economic nexus. And you're now collecting sales tax where you've never had to collect sales tax before, and you've got a system that works just fine, except it worked just fine because you're an Ohio-based company and the sales taxes are county-based in Ohio, and 5-digit zip codes work just fine in a county sales tax. They don't work with a hoot in a city sales tax. And heaven forbid when Missouri's law goes into effect, because Missouri has 2,200 local taxing jurisdictions. Now, the good news is only the state can audit you in Missouri. The bad news is it's virtually impossible to get the right answer in Missouri because the opposite side of the street is a different taxing jurisdiction. The opposite side of the street can be 3 different taxing jurisdictions, all different than the one that you're in. Now, the good news about economic nexus is like physical presence. Once you leave, if you close your store in Wyoming, you don't have to collect sales tax on those. You have no sales. You can stop collecting. And the same thing with economic nexus. Once you've fallen below an economic nexus threshold in the state, you can stop collecting their sales tax. But you have to remember there's a timing that goes along with this. So these are calendar year based in every state except for Illinois and California, which are quarterly based. So in every state that says, yeah, if you fall below the threshold in 2022, you can stop collecting sales tax in 2023. You got to wait till 2023 to stop. You can't stop because you're not going to get done. You don't think you're going to get there this year. Once you started collecting, you need to continue to collect until you've literally and legitimately fallen below the threshold. Now, this is a good news, bad news story about virtual audits. The good news is the states have realized that all of us are becoming dependent upon electronic documentation for our own business purposes. So we don't have paper anymore. And that's a good thing for us because it makes us more efficient. It's a good thing for the states too, because it makes them more efficient. So in theory, those of us that have all our records electronically, we could just send them to the auditor, and the auditor never has to show up. In theory, that makes audits go quicker, and they're less maybe painful to go through because you don't have to look at that person every day. You don't have to make space for that person. The bad news is that the real reason why states want to do virtual audits is because they have wasted historically a lot of time traveling, and all that time that their auditors spent in a car driving to a different city or on a plane going to a different city can now be put back into the audit process. And we're going to see more audits because they're more efficient and they can do more audits per person than they've ever been able to do, because we have taken it upon ourselves to be more efficient. So we're going to see more audits. We may not see more auditors, but we're going to see more audits because they have figured out that they've got what they need to do from the luxury of their desk. One more thing, there's a risk here, there's an audit risk here, and we're not yet far enough into this to really appreciate it. You know, when the Wayfair decision happened in 2018, the states took that Supreme Court case and they applied it to marketplaces. And they said to marketplaces, we're going to make you collect sales tax. We're going to deem you to be a retailer. And we're going to make you collect sales tax on the stuff that's facilitated through your marketplace, even if you don't own it, and even if you've never collected sales tax in your life. So all of us that are starting to collect sales tax in the state that we've never collected in before, you know, for the most part, most of us have collected sales tax somewhere. There were a lot of marketplaces that had never collected sales tax anywhere because they never sold anything of their own. They always sold, they facilitated the sale of somebody else's product. It was somebody else's obligation. Well, the states have eliminated that. And they've simply said, now you marketplace, you meet this definition of a marketplace, boom, you're a retailer. And you have to collect sales tax. Now, from an audit perspective, obviously marketplaces are not going to be subject to all the audits. From a good news perspective, marketplace sellers, in theory, will have less marketplace audits. Should, in theory, have less audits. But it's going to be years before states figure out how this all works. And in the beginning, they're going to audit both the marketplace and the marketplace seller just to make sure they understand. And they're going to hold both of them liable if something isn't right. And another audit risk here is all these marketplace facilitator laws that every one of these states have adopted have one thing in common. They all relieve the marketplace of liability to extent that the marketplace seller has made a mistake. So if you sell in a marketplace and that marketplace makes you map your products to their system, if you are the one that's contractually obligated to do that, to get your stuff sold in that marketplace, that is where the marketplace will shift the liability. So if you make a mistake and you say you're selling shoes and you somehow mistakenly map them to food, and the marketplace system said food's exempt, but shoes are taxable, but they don't know you're selling shoes, and they get audited, the marketplace gets audited by a state, and the state says, well, you're not selling food, that person's selling shoes. That's taxable. The marketplace is going to come back to you and say, your contract with me obligated you to do that, and because you didn't do it correctly, I'm going to shift the liability from this audit assessment to you. So from an audit perspective, you need to be very careful how you're interacting with these marketplaces, because they have first liability, but they can pass that back to you to the extent that whatever caused the audit is your fault. And then lastly, you know, because the pandemic messed up our supply chain, a lot of people have changed suppliers, or they've changed who they wholesale through or who they retail through. And when that happens, all that exemption certificate paperwork that you had in place becomes worthless. Well, not worthless. It becomes an historical anomaly. You have to keep it. It's an historical anomaly because you have to keep it until the statute of limitation runs in whatever state that sale occurred in. So you can prove that sale you made 2.5 years ago was a legitimately exempt sale because it was a sale for resale. But because you've changed suppliers, you've changed wholesalers, you have to create that documentation all over again. And this is an area where states find mistakes. And often they don't find mistakes, they find gaps. What they find is they come in and they audit someone and they say, in audits work exactly the same way in every state. Auditor comes in and says, I want to look at all of your exempt sales for October and May and February for the last 3 years. So they're going to do a random sample. They're going to pick 3 months out of a year for the last 3 years, or Wisconsin, where it's 4 years. And they're going to say, I want to see all your exempt sales, all the invoices you did where you didn't charge sales tax in those 3 months for those 3 years. And I want to see all your purchase invoices for the same months for the same 3 years. And then they're going to do a random sample. That's what they call a random sample. They're going to look at those 9 months worth of records, and they're going to look for errors, and then they're going to extrapolate that error. They can turn that into a percentage, and they're going to extrapolate that to 100% of your purchases and 100% of your sales, your exempt sales. They may look at the taxable sales you made, but it will be cursory. They will look to see, oh yeah, she's charging the right rate. We're good. But they make their money on exempt sale mistakes and on the use tax that you should pay because you purchased something from somebody that didn't charge you sales tax. And that hasn't changed, and it's going to be a while before that changes. The exemption thing will never change. But in theory, as Wayfair makes it retailers out of everybody, makes tax collectors out of everybody, in theory, use tax should really drop. And there should be a lot less use taxes owed in the United States because there's more people collecting sales tax. But that is not yet played out, and the auditors haven't yet got that out of their system. So when they walk in and they ask you for February's exemption certificates, they're going to want you to prove, okay, you sold 1,000 things to 1,000 people that you didn't charge sales tax on in February. Show us the paperwork. Show us why those things were exempt. Carl, that is what folks need to be thinking about as they prepare for audits in the world of economic nexus.
Well, Scott, thank you. Points out to me, as I've known for years, but it just continually changes and gets more complex. And it's one of the reasons we have the partnership with Avalara that we do, because you guys really help our customers to stay aware. And the software that we work with you guys on helps them stay in compliance, and reporting, help and all kinds of things that has just become a greater burden than ever before since the Wayfair decision. So thank you so much. I do have one question that comes to mind today, Scott, and that is, most of our customers, we started out in the United States and Canada, but we do have businesses that have, other locations and whatnot in other countries. How does Avalara work, kind of with international business?
Well, thank you. It's, the great news about the internet is that, there's no reason why someone can't be a retailer all over the world from the luxury and comfort of their home. In many ways, it's similar outside the United States. It's a different tax. Outside the United States, it's called a value-added tax.
Yeah.
And that is a very different tax from a sales tax, because the tax applies at every stage in the life cycle of a product. So when the iron ore miner digs iron ore out of the ground and sells it to a smelter, the iron ore miner is a taxpayer, and they charge the value-added tax to the smelter. The smelter turns it into steel. She sells it to a manufacturer. They're a taxpayer. They will charge the value-added tax. And the way these things generally work is that, the tax rates are higher. They're often 20-25%. But they're intended to be a tax that applies to the ultimate consumer. So in the life cycle of a product, if someone is charged the value-added tax, they get to take a credit when the next time when they sell their thing, they charge the value-added tax on the value they added, which means they get to deduct the tax that they were charged by the person who added value at the earlier stage of the life cycle of that product. In a value-added tax, you have many, many, many more returns, and you have tax remitted throughout the process of manufacturing a good. until you get to the very end, and then the full rate is charged to a consumer. But throughout that process, there's been a deduction taken. So in a value-added tax, you're going to file a lot more returns, and the rest of the world uses a value-added tax, and we're one of the very, very few places that use a sales tax. In addition, as you cross borders, you encounter tariffs, you encounter other types of fees that go along with doing business internationally. And the same thing when people are making sales in the United States. There's things that are subject to tariffs here in the United States. If you're selling from Europe or South America into the United States and you sell something that is subject to a tariff, you have that tariff has to be paid before the product can be brought into the United States and delivered to the ultimate consumer. But we have Avalara has a product that deals with all of those things. We have a remarkable product that classifies goods so that you know exactly what goods and services code your product is subject to in a different state, and whatever tariffs and value-added taxes go along with that. So the process works from our perspective, works exactly the same, even though the process itself is very different.
Right. Understand. Well, thank you, Scott. And let me just remind everyone that, Avalara and Vision 33 are partners. And if you're interested in any of the services of Avalara, whether that be, a risk assessment that you'd like to go through, or if you're interested in the software that helps you to calculate tax in real time for your sales process and your sales orders, and to track all of the nuances of every state automatically, all of that can be done. And so we encourage you to contact our customer relationship managers, and they will put you in touch with Avalara and help you to understand exactly what the solution does and how it can be beneficial for your business. Scott, once again, thanks as always for joining us and sharing things with us. And we'll look forward to checking back with you guys again at Avalara in another few months, just to stay up to date on these very important business matters.
Thank you, Carl. We appreciate it.
Until then, everyone, we'll see you on another version of Wednesday Web Chat very soon.